Hey everybody, good to be here. My name is Brent Moore. It's time for managing an options portfolio. Today, what I want to talk about is some decisions you make. How do you decide on what option strategy is going to be most appropriate for you? So we're gonna talk about that, and of course, we're going to manage existing positions. You know, I have a class, a long options class. I have a advanced options class where often we do short options. So we really kind of run the gamut, and I'm using this webcast here to try and help us make management decisions on those, because that's what this this class is all about. So I'm glad you're here. I see some familiar names in the chat. Glad you're here. And if you're watching on a recording, I'm glad you're here as well. One person I'm really glad is here is Mr. Mike Fairborn, who's helping me out in the chat. So make sure you check out Mike's webcast as well. You know, I've worked with Mike for many years. He's a good friend and an excellent coach there. You can follow either of us on X at Brent Moore CS, at Mike Fairborn CS. So let's go through some disclosures, okay? So options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Paper money application is for educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risk, including risk of loss. Let's see, past performance of any security or strategy does not guarantee future results or success. There we go. I'll be looking at examples today, different individual stocks, individual options. They're not recommendations though, okay? Those are not recommendations. So let's go ahead and let's get to it. Let me go and I'm gonna bring up the Thinkorswim platform, and let's bring up the chart and we can look at the markets. Let's just look at the S&P 500. You can see strong run that we've had of late. We're kind of, we've broken slightly above those highs there that we had. So strong bullish runs. General trend has been up. Sometimes when the market has gone up this far, this fast, you expect kind of a consolidation period. You know, a little bit of a rest maybe, but who knows? You know, who knows? When we're trying to decide on option trades though, and this is really the point of our class here today, is we're trying to decide option trades. What I'm going to suggest to you is there's kind of three main things that you need to figure out, to decide upon when you're deciding what options class you want here, what options strategy you want. So for example, the first thing maybe is, what's your forecast? In other words, are you bullish? Are you bearish? Or are you neutral? Okay, that's a key thing, obviously, in figuring out an option strategy. When you're looking at this, things you can look at are, you can look at things like trend, you can look at support and resistance, you can look at certain indicators to try and get a sense of momentum there. So that's the first thing I want to do, is try and find, you can look for bullish, bearish, or neutral, and we'll go to the others in just a sec, but let me just do this. As you scroll down, and I'm going to stick with the S&P 100 here just to try and get more liquid options. As I look at this, it's easy enough to go and just kind of look at the trend. And I can say, oh, the trend has been down on American Tower. If I wanted to, if I were going to do a trade on that, that would be a big consideration. And I can go on down the list. But another consideration right now, because of earnings, now we have a ton of earnings coming out on this list. Any of these stocks that have this red and blue, red circle, blue circle, have earnings coming up soon. And so I may decide to skip through some of those if I want to avoid earnings. You don't have to. You can do trades that actually take advantage of earnings and try and plan on earnings. But there you go. That's the trend is the thing to look at, and then consider things like earnings on here. Here's Adobe, maybe more bearish on Adobe. Because more of the trend has been down on Adobe here on this. Let's look at, I want to go down. I want to find some that don't have earnings here. Here's Bank of America. Here's a bullish trend. Okay, generally we've been going higher on this. And so, if you were looking for a bullish trade, sometimes you look at a trend like that and go, well, that may be more bullish. Now we may take into consideration more of a potential resistance there where our high was, but that's the first thing on our list is to check out your market forecast on that, your forecast for your stock. Okay. Let's do this. Let's look at number 2. And what I want you to consider is this more of a buyer's market or a seller's market? Now, sometimes we do this, and I don't want you to mistake this. By buyers, I don't mean bullish. By sellers, I don't mean bearish. When I say buyers, when I'm talking about for your options, what is your IV? Is your implied volatility, and where do you think it's going? Okay, that's really the consideration. If your IV is high and you think it's going to go down, then you would be more in the seller's market area. If your IV is low and you think it's going to go up, then you'd be more likely in the buyer's market. Now, it's not always that clear cut, because sometimes your IV may be low and you think, well, it's actually not going to go up. I don't think it's going to go up. So there is some ambiguity in that, but implied volatilities are things to look at. Let's do this. Let's look at the VIX here for a sec. I'll come back to Bank of America in a sec, but let's look at the VIX and just kind of see. I'm going to go a little bit far longer term on the VIX. Let me go out. We'll go out 3 years on the VIX here. And we can see where we're at on the VIX right now. We're right around 15 on the VIX. Okay, we're right around 15 on the VIX. And it's kind of tailed off a little bit lately. It could certainly go lower. And if the market goes up, we'd expect the VIX to probably not go up, or maybe go down, tail down a little further. So there's a little more room on the downside. But if it goes, it could go back up here as well. So Scott says, I think the VIX is going to spike up next week. And if that's the case, you may consider more of a buying type transaction. So generally, when we talk about buying type transactions, we're talking about like a long call or a long put would be a buying type transaction, which would take advantage of an increase in the VIX here. So that's kind of your consideration. Now, when I say long call, long put, you could also there's variations of that as well. I could do a long call vertical or a long put vertical, for example. So it's not just those. And remember, when we do vertical spreads, you're going to have a long option and you're going to have a short option. When you have a long option and you have a short option, one is going to be positive vega. One of those, the short option, is going to be negative vega, and they're going to partially offset each other. So this is the bigger issue with this is if you're doing just a single long call or say a single short put, you're going to have much more volatility effects on it than if you do a spread trade. Okay, I'm hoping that makes sense there. Now let's move forward here. Let me just close that down and let me do this. So here, my theory is on this is the VIX, if the market, I'm going to assume the VIX is not going to go up, spike up here. But in this case, I'm going to have more of a neutral forecast on the VIX here on this. Because sometimes, you know what? It's more just neutral and it's not either of the two. And the final thing that I want you to consider here is, are you looking for a high probability trade or a higher potential reward trade? Okay, so that's this. So for a higher probability trade, you're probably looking more at, say, a higher probability trade, something like a short call vertical, a short put vertical. A short put itself would be a high probability trade. A higher but keep in mind, those, you're very limited in your gains. A higher potential reward trade is one like, say, a long call or a long put, where you can certainly make more on those, but you sacrifice the in terms of reward, you sacrifice the probabilities there. So it's kind of a balance. It's a balance between the two. If you think of a teeter-totter, higher probability generally means lower potential reward. Higher potential reward generally means lower probability, okay? And there's all sorts of variations in there. But those are the three main considerations that you need to consider as you're doing this, all right? So I'm going to go back to our Bank of America here. I'm going to go to BAC, and I'm going to go to a shorter term time frame. I'll pull up my moving averages here. I have a 20 and a 50-day moving average, the 20 days in red, the 50 days in blue, and generally the trend's been going up. We're above our moving averages. They're upward sloping right now. We've come back down to them. Some traders actually like to look for the bounce there. I don't think it's necessary. We are past earnings, so we're not dealing with earnings here on this right now. And so this looks kind of like a little flag pattern on this right now on this. So what I'm going to do here is I'm going to look for a trade that is going to be a trade where I think we've had a pretty strong move in the market. And I don't know, this could continue to go up very strongly, this market. But after we've had this big of a move on the market, it wouldn't surprise me if we took a little bit of a breather on the market as a whole. But what I'm going to do is I'm going to still take a somewhat bullish posture, albeit a higher probability bullish posture on Bank of America right now. So in our example trade, I'm going to do a short put vertical on this. And then we'll talk about managing this. And we have some other short put verticals. We have long verticals. We have other types of trade we're going to look to manage in just a little bit. But I'm going to look at a short put vertical because I'm bullish on this stock. Somewhat bullish though. So I'm going to put little squiggly lines in front of that bullish, saying it's not super bullish. I want to emphasize the probability. I want to say it's a higher probability trade. I'm going to sacrifice some potential reward on this. And I'm going to assume the IV is kind of neutralish on this, okay? So that's that trade. Now, let's say you were bearish on this. You felt, this is going down. I think the market's going to pull this whole thing down. The market's going to fall down significantly. Then maybe we do a short call vertical instead, or a long put. But maybe if I'm bullish and I wanted a higher reward potential, and I'm willing to sacrifice the probability. In that case, I would look at, say, a long call, just a straight long call would be an example. Or let's say I felt the IV were going to spike here. Well, that may push me more towards the long call or long call vertical there on this, okay? Motion says, hey, the MACD is going down, and that probably doesn't surprise me, the RSI is going down. Yeah, when we have a pullback, when we have this, it's not surprising you're going to see that indicator come down like this. But what I'm looking at is this, the general trend here on this. All right? So that's the trade I'm going to do, and we're going to add that to our portfolio here. And then I want to talk about management of this. So if I'm going to do this, I'm going to say, hey, where's my support? Well, I'm assuming my moving averages are going to act as a support level here on this. So what I'm going to do is I'm going to go to my trade tab. I'm going to go out, and I can do however much time I want on this. You know, very often we say, well, 30 to 40 days. Look, I can go out 16 days here if I want. What's the pros and cons of going out longer or shorter? If I go shorter term on this, let's say I want to target a delta that is, let me pull up a delta here. Hold on one sec. Okay, let's say I want to pull up a delta that is around 30 or more. Here's the thing. Delta, first of all, let me just say this. Delta measures how much an individual option is going to move in relationship to a stock price. Okay? That's an expectation of it, right? But we also use it sometimes as kind of a measure of probability. And so we'll use a delta as a way of kind of deciding what strike price. For this contract, out 16 days, if my delta is 29, what I'm going to find is if I go out 30 days, my delta is going to be a little bit different. It's probably going to be a little bit higher in that case. Because as you get closer to expiration, deltas tend to go more towards either 100 if they're in the money, if the option is in the money, or 0 if the option is out of the money. That's as you get closer to expiration. All right? So in order to get a delta that is a little bit higher, I'm going to have to go a little bit closer to my stock price here on this in order to do that. So, for example, let's go out, we'll go up 37 days here. And we were saying, we were looking at 45 strike. Look at my delta here. My delta is a 34 delta here on this. If I go out a little bit more time, that's giving me a higher probability that this is going to end up in the money here. Any questions on that? Is that making sense? So let's look at it another way. If I'm closer to expiration, let's say I have an expiration right here, there's less possibility of this stock going up more or less more. There's less likelihood of it going up a significant manner. Therefore, to get any sort of credit on this trade, I'm going to actually have to go to a closer strike price than I would otherwise. So it's not that you need to do a 30 to 40 days till expiration, but in order to get the premium that you want, you may need to go to a closer strike price here on this. So here's what I'm going to do. Let me just get a couple more strikes on this. And let's just compare my 45, 44 short put vertical. I'm going to do that. And I'm going to do this here. Okay, there's my short put vertical. It's giving me a 19-cent credit on this. 19-cent credit here. But if I go out to, say, February 28th, my credit is 25 cents. See the difference? I'm getting a much higher credit by going out more in time. I'm also giving the trade longer to go against me, to work against me in that case. So don't feel confined. Just make sure it meets your parameters. Generally, when I'm looking at a 19-cent credit, what's my return on risk on that? Well, let's see. If I go out to February 7th, let me click on confirm and send. And let's just see what we got. We got 19 cents or $19 max profit. I'm going to divide that by my max loss of 81. That gives me about a 23% return on risk. Okay? For some traders, that's absolutely fine. Some people will do this. They'll say they want at least 1% return on risk per day of we're going to be in that trade. At least 1% return on risk per day we're going to be in that trade. Well, how many days are we going to be in the trade? We're looking at 16 days in the trade. Therefore, that may be a sufficient amount for you. Some traders say, look, 23% is, I want something at least 30% on that. But in this case, I'm going to go with this, and I'm going to confirm and send this trade. And I'm going to throw this trade in our short verticals category. And Frankie did the calculation for us on the February 21st contract, about 31% return on risk. So you're getting a higher return on risk if you go out a little bit further there, given the same strike prices. Okay? So now, how do you manage it? We just got in a trade and on Bank of America where we have a 45 and 44 strike. So let me just draw a couple lines here on my graph. Our strikes are 45, which is right about here, okay, and 44. If this stock fails to bounce, our expectation is this stock is going to trend up. But if we start to break below this level, we're probably going to look to get out of that. Otherwise, we're going to wait on that trade. So let's look at some other examples that we have of trades and discuss management of those trades. So I'm going to start here. We'll start with the top, short verticals and iron condors. Now, iron condors I have in the same category as short verticals, because when I have an iron condor, it's essentially just two short verticals put together. There's a short call vertical and a short put vertical. How are we going to manage those trades? The way we're going to manage those trades is individually, typically. In other words, we entered it as an iron condor, but I'm going to look to manage this as a short call vertical and decide whether I want to be in this side as a short call vertical. Broadcom right now is at $246 and change. Right now, my short calls at 260. So we're still a little ways away from that. This is a neutral trade. I want the stock to stay between my strikes. My short strikes are 260 for the call. My short strike on my put is 220. I want the stock to stay right in between those two. Well, where are we at right now? Right now we're at 246, which is more or less in between the two. We're a little bit closer to that call side. But unless I've turned bullish on this trade, I've still got 30 days to go till expiration. I'm going to sit with this trade. Okay. So let's just see. 260 and 220 are our strikes. Broadcom. Hold on one sec. I don't have my, just do it this way. AVGO. Here's Broadcom. Am I bullish on this? No, probably not yet. I got in this as a bearish trade. You can see the channel I drew before. And my assumption is this is going to bounce before we get too bullish. So I'm going to stick with this. This is a positive theta trade. If we start to break above our our resistance levels, we'll say, then I may look to get out. Otherwise, you know what I'm going to do? I'm going to let that positive theta work on this trade. We're making about $3.15, which isn't a ton, but it's every day, including weekends, we make that theta on that. So I'm going to stick with that AVGO trade. Does that make sense why we're sticking with that trade? Both the call side and the put side are seem to be okay. Bank of America, we already talked about that one. Let's do FDX. FedEx, where's our stock? Stock's at 273. Where's our strikes? Short strike on the call is 285. Short strike on the put is 260. As long as we maintain a neutral posture on this, I'm going to stick with this because I still have 16 days to go. Once we get below about 10 days, then we may look to exit even if it is doing well. But on these iron condors, they're kind of slow moving trades. Look, we've made all of $73 on this iron condor here. Not a ton of money, but that's what you sign up for when you do an iron condor. So are we still neutral on FedEx? And let me just show you a little trick here. One sec, let me get rid of this. If you want to, when I go over here, this is not linked here. I can't just click on FedEx and have it come up. But you can add a column if you want. And the column is send to, and then you put whatever color. I have my thing as 7 orange, but it would be just whatever you have on yours. Then I have this right here, and if I want to bring up FedEx, I can just click on that, and then when I click on charts, it pops it up right there. So little hints there on using Thinkorswim. Am I bullish? Am I neutral? Am I bearish on this? This is an iron condor. This is how we entered it. We entered it as a neutral trade. We're going to stick with this. Our strike prices aren't in danger, and we're staying neutral. So we're going to let that time decay continue to work on FedEx. Okay. There's FedEx and my theta, about $6 or so a day, $6 to $7 a day in theta we're gaining on this. Let's look at Nike. Nike, we're losing money on Nike. Okay. What do we have on this? We have a short call vertical 74.77. Now, we don't need to get out because of time frame, but we entered this as a bearish trade. And if we're no longer bearish on this, it may be time to get out or at least put in an automated exit on this. So let's take a look at Nike here. Okay. 74.77 is our strike. You see, you can probably see kind of why we did a bearish trade on this. The trend was down on this. Now, we've had a pretty strong run up lately on Nike, and that's what's causing us our issue here on this. We have a strike at 74, which is just, we're breaking through that. Okay. Now, and a strike at 77. Here's what I'm going to do. I'm going to look to exit this trade right now. And the reason is we're breaking above the short strike, and this looks like a pretty strong bounce here. Now, another option I have, and I wouldn't begrudge you for something like this. I wouldn't say this is a wrong approach. You could draw a diagonal trend line, okay, on this. Let me just do this. And I could say, look, here's my trend on this. I'm going to wait for this to break this trend, and I'm going to get out if we break that. That's, by the way, coincides mostly with our 50-day moving average. So I think if you wanted to, that's certainly a justifiable thing to do on this. But I'm going to cut my losses short on this. This really seems like a very strong bounce here on this. And I think I'm just going to get out of Nike on this one here. But you could go either way. But what we're not going to do is we're not just going to let anything happen probably and let it continue to go up here. So what I'm going to do is I'm going to actually just exit this trade. I'm going to highlight both of these. You can just hold down your Control or Shift key to highlight those. I can right click on it. I can create a closing order. Here we're going to buy this back. Now here's the mid price at 130. Natural price is 1. I'm going to go a little bit in between those two. Hopefully we get filled there. And I'm going to confirm and send, and we're just going to get out of that. Okay. And so we lost a little bit of money, not that much on Nike. So I'm just going to cut that loss short there on Nike. Now let's go through. We got one more short vertical, and then we'll get to some other types of trades as well. Okay. We got another, well, Iron Condor, 2 short verticals, 96 and 88 are our short strikes. I keep pointing out, this is an unbalanced Iron Condor, by the way. So notice I don't have the same number of strikes, but that doesn't really matter here for our management purposes. There are 2 individual vertical spreads. Are either one of these getting threatened? Is my 96 call threatened? And my stock's about 92.5. My stock is right in between roughly my call side and my put side. So this is a neutral trade. As long as Walmart is staying neutral and I have more than 10 days to go, which I do, I'm going to stick with this. Let's take a look at Walmart. And you can see why we got in, kind of more of a neutral pattern. I see no reason to get out of this at this point. We're going to let our theta work on that, our positive time decay work on that. Okay, so any questions on management of short verticals? What we're going to do with them is, in general, we need to be patient with short verticals because time decay is helping us out on those. Once we get under, 10 days, a week to go till expiration, we're going to look to exit those. As long as it's not breaking our forecast, breaking resistance levels or support levels that go against us, then we're probably going to be patient with those type trades. That's how we're going to manage them in this class, right? Okay, so let's do this. Let me go to out of short vertical mode to long single option mode. So for long options, we're going to consider, here's American Express. This was a trend trade. As long as and it's a call, okay, so we're bullish. As long as the trend is continuing to go up, we're going to stick with this. Now we're doing quite well on this. We're up $800 on this. I may want to protect myself there. Okay. So let's just see where our stop is on this. I have a conditional order. I don't think it's going to tell me if I do that. So what I'm going to do here is, let me go to my working orders. I'm going to go to American Express and just see what we got on this. I've got an order to exit if we go below 301.5. $301.5. So let's take a look at this. American Express, long call, we're bullish on this. Still bullish, that doesn't change. We do have earnings, but that's not going to get me out of the trade just because we have earnings. But my stop down here, or my exit is down here right now. Could I move that up a little bit? I think I can move that up a little bit. I'm going to move that up below maybe these days right here. So I'm going to move it up to about, we'll move it up to about 309 here if we break below that. And just to try and protect any gains we have on that. So what I'm going to do is I'm going to go here. I'm going to right click on my order. I'm going to cancel and replace this order. This is my order to get out. My gear is going to tell me where we have. And we said 309, just to try and help protect some of those gains. Because I really do have pretty good gains on that, but things are looking pretty good right now. Now, keep in mind, just let me confirm and send that. That's going to update that cancels the old one and it replaces it with a new one. Now, let's say we come out to earnings and American Express has a terrible earnings and it drops down to $300. Okay. Is this going to, get us out when the stock is right at 309? No, the stock is gapping down. So even though this is not technically a stop order, it's a conditional order to get out at a certain price. The same principles hold as with the stop. It doesn't guarantee what any price of it's getting out. Our max loss on this is still the full amount of the trade. But I'm going to stick with this trend. The trend's going well. We're doing well on this. There you go. Okay. Let's look at some others here. Okay. BIIB, we have a long put. So bearish trade. We've got 30 days to go on this. When did we enter this? We entered this on the 14th. That was a week ago. Okay. We entered this basically a week ago. Oops. I didn't mean to do that. Okay. And how are we doing it? We're up a little bit on this, not a lot. So when am I going to get out? Well, here's when we get out on our, this is a shorter term trade. And I'm going to get out if we get close to expiration. We still have 30 days, so I'm not going to worry about that. I'm going to get out if we break say a resistance level on this. Remember, this is a bearish trade. It's a long put. So in other words, if we are bearish and it goes bullish, we're going to look to get out. We have a stop in there, but we're probably not going to need to adjust the stop given that we're only up $25 on this. That means it has not gone our way that much. But here's one other reason I may get out on this. If I'm getting out on this trade, if I got in because this is bearish, and maybe it doesn't look that bearish and it looks just kind of more neutral now, because our time decay is working against us. We have about $9 a day of theta working against us. This goes back to that earlier discussion that we had about higher probability or higher potential. This is a higher potential trade. We can make a lot of money on this, theoretically, if the stock goes down a lot, but the probabilities work against us on this, and theta is working against us. Time decay is working against us. So even if it's not super bearish, if it's no longer bullish, even if it's not super bullish, because this is a bearish trade, even if it's just kind of going neutral, we may consider not sticking with this trade. So let's take a look at this. Oh, you know what? This is doing exactly what we want. I would not say this is neutral right now. I would say, and look, there's a lot of different ways. This is not, my approach is not the only way, and technical analysis is not the only approach in trading. But in general, I'd say this general trend is continuing on. So we're going to stick with BIIB here on this. Okay, let me move forward here. I got to go a little faster on some of these. Microsoft, long call. Obviously, we're doing well. We're up $1,700. May need to adjust that stop price on Microsoft. Let's see what we got here on this. Here's Microsoft. It's a 33.67 stop. Where's my trade price? My trade price is $48. I'm going to move that stop up here. I'm going to go 48. We're in the money a ways on there. I'm at an 85 delta here almost. I could even roll this. I'm not going to roll it this week because of time, but if this stays up at that higher delta, I may roll this out, take some of those profits off the table. Well, maybe we do that this week. Let's do that. I may not be able to get to everything else, but I think this is very important. If you get up to an 85 delta on this, assuming we bought at, say, something like a 70 delta or 60 to 70 delta, then that means you're doing pretty well on the trade probably. I made unrealized, it's a paper trade, unrealized $1,700 on this trade. Let's roll that. How about? Let's do this. So what I'm going to do is I'm going to cancel this sell order. I'm going to close this down. and I'm going to cancel that order. And what I'm going to do is I'm going to say, look, Microsoft, we're doing well on. Let's pull it up. MSFT. I'm still bullish. I'm still going to consider this trade to be bullish. But what I'm going to do is I'm going to roll this out to a lower delta. So let's go here. This trade, initially, we went out to May. We're still 114. We're still a ways out on this trade. But what's going to be the result if we roll it? Well, number one, we will realize some profits. Okay. We'll realize profits. That's nice on that. Okay. Another thing is we'll have a new trade with a lower delta. Okay. When we roll it out to a lower delta, what does that mean? It means it's going to be, if the stock then turns and goes against us, we're actually going to lose money at a lesser rate than if we keep something with an 85 delta. Because if we have an 85 delta and the stock goes down, say, $10, then what we're going to be losing is about $8.50 on the option. If I have a 70 delta or a 65 delta and we lose $10, then we'll be losing $7 or $6.50 on the option. Now, that sounds great. Of course, if the stock continues to go up, we're also making a little less dollar for dollar on that trade there. So let's do this. Let's look for something 60 to 70 delta on Microsoft here. So I'm going to go here, Microsoft. I'm going to stick with May. I'm going to stick with the same expiration. I'm going to go to my delta. We told you what delta was earlier. I'm going to go to about here. I'm going to go to that 430 strike. That's a 66 delta, 430 strike. And here's what I'm going to do. I'm going to do this. Now, remember, when you roll, it doesn't save you on commissions. Essentially, what you do is you're closing this out and just doing another trade, except we're just going to do it on kind of one order ticket. I'm going to create a rolling order. Now it says calendar. I'm not going to change my date. I'm going to stick with May 16th. But instead of 390, we're going to 430. 430. Okay. This is going to give us about a $3,000 credit on this trade. I'm going to go, that's the mid price. I'm going to get filled on this. So I'm going to just move it down a little bit from there. And I'm going to confirm and send, and then send that order. Okay, so that's a nice little credit. That's taking profits off the table. Now, effectively what happens is, instead of showing, I forgot what our PL open was showing before, we reset that PL open, okay? Because this is a new trade. When we roll, it's a new trade. And so we don't get to see that nice PL open there anymore, but we also brought in, I think $3,000 in terms of credit to our account? That's great. Here. Now, I'm also going to want to put an exit order on this, and that'll be the last thing we do here. I'm going to look to exit this trade, and I'm going to go to about a 70% stop. Trade price was 35. I'll go 65% because we're down to 65 delta on this. So that's going to give me a 2275 stop order. I'm going to right click on this. I'm going to create a closing order. I'm going to sell this, and we're going to put this in at 22.75. Good till canceled. And that's going to be a stop. Stop, 2275, good till canceled there. Okay, confirm and send. And I'm going to send that. And now I have a stop on my new trade. We rolled that out. I'm hoping that's helpful. We talked about, folks, managing short verticals and iron condors in depth. We talked about rolling out and managing long single options today. And of course, we talked about those three main considerations when you're deciding on an option strategy: your overall forecast, whether what implied volatility is doing, and whether you're going to want to do a higher probability trade or a higher potential reward trade. I want to thank you for joining me today. Thank you, Mike, for helping me out in the chat, of course. Coming up next, we have trading price patterns here. So make sure you check that out and make sure you subscribe. Everybody have a great rest of the day, and we'll see you all same time next week. Bye-bye, everybody.